Welcome to the Deep Dive, the show where we cut through the noise and hand you the absolute best insights on topics that shape our world. Today, we're not just digging into the Earth's hidden treasures, we're digging into how we account for them. Imagine something you literally pull from the ground, use up, and, well, it's gone forever, at least in that form. We're talking about natural resources, sometimes called wasting assets, and this really unique accounting process called depletion expense. Our mission today is to sort of unpack how businesses track and allocate the costs tied to pulling minerals, timber, or oil out of the ground. We want to make sure you gain a clear, well-informed understanding of this specialized area. Now, before we dive deeper, just a quick reminder that this deep dive is based on material from Farhat lectures. All the content, examples, and explanations we'll discuss here are derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or even a seasoned professional, do visit the website for additional practice questions, video lectures, and detailed support to reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material for us to explore. Okay, let's unpack this then. When we think about assets in accounting, we usually picture things like factory buildings, machinery, maybe even patents. But these natural resources, they seem fundamentally different. What exactly are these wasting assets, and why do they get their own special accounting rules? What makes them so unique compared to, say, a building that just kind of sits there providing a service year after year?
That really is the core question, isn't it? What's interesting here is that natural resources, think petroleum reserves, mineral deposits, timber stands, they're distinct because they are consumed directly and permanently through extraction. Unlike a factory you can maintain or repair or even rebuild, these assets physically diminish as you use them. There are two really distinctive features that set them apart in accounting. First, the asset is completely consumed through extraction. You pull that oil out, it's physically gone from that specific deposit. Second, and this is key for the long-term view, replacement is only possible by natural processes, geological processes, over vast timescales, not by human action. You can't just rebuild an oil field overnight or regrow a mature forest in a couple of years. So this fundamental difference means natural resources aren't just assets like others. They're essentially finite capital. Their accounting has to reflect that irreversible consumption. It really changes how investors might view companies that rely heavily on them. They're literally selling off a piece of their non-renewable asset base over time.
And these features lead to a couple of main accounting challenges. First, figuring out the initial cost basis of the resource that we call the depletion base.
Yeah.
And then how you systematically allocate that cost as the resource is used up. That's the depletion part. It's all about matching that disappearing asset with the revenue it helps generate.
That makes perfect sense. So if these are unique finite assets, figuring out their initial price tag for accounting this depletion base must be equally unique. It can't be as simple as just the purchase price of the land, right? What actually goes into building up this foundational cost?
Exactly. The depletion base isn't just, the sticker price. It's a comprehensive sum, really. It includes 4 distinct cost categories that all contribute to getting that resource from the ground and ready for market. We're talking about acquisition costs, exploration costs, development costs, and importantly, restoration costs. Each one plays a specific role. Let's start with acquisition costs. These are basically the amounts a company pays just to get the legal rights to explore or exploit a resource on a piece of property. Think of it like getting permission to even look for something valuable or to start pulling it out. This could be upfront payments for property rights, maybe long-term lease payments, or even ongoing royalty payments based on extraction amounts. Initially, these costs often sit in an asset account called undeveloped property. It's kind of a holding place on the balance sheet. It holds the costs for land or rights where resources might be, but you haven't proven it yet or started extraction. Now, if your exploration pays off and you find a viable resource, these costs then get transferred to the specific natural resource account, like oil reserves or timberlands. But, and this is a big but, if you drill and find nothing viable there, those acquisition costs for that plot are typically written off as losses. It really highlights the risk involved.
Okay, so that's the entry ticket, basically. What about actually finding the stuff, the exploration costs?
Right, exploration costs. These are the often significant expenditures you incur to actually locate and confirm the resource after you've got the rights. We're talking geological surveys, test drilling, seismic study, all that investigative work. And it can be incredibly risky and expensive. For large oil and gas companies especially, because of the sheer uncertainty and risk, these costs are typically expensed immediately, right to the income statement in the period they're incurred. Imagine spending millions on a test
well, only for it to be a dry hole. That's a direct hit to current profits. It's not something you usually spread out over years.
Wow, so that could make earnings pretty volatile for companies doing a lot of exploring.
Absolutely. It highlights the high-risk, high-reward nature of the business.
Yeah.
Now, for smaller companies, maybe these costs are a huge part of their budget. In some cases, they might capitalize them if they're material. But for general accounting practice, like for the CPA exam, the default assumption is usually that exploration costs are expensed unless you're explicitly told otherwise.
Gotcha. Expensed unless stated otherwise. Okay, so you found something promising, now you have to actually get it out. What about those development costs? Sounds like heavy lifting.
You bet. Development costs are all about getting the site ready for actual extraction. These usually fall into two buckets, tangible and intangible. Tangible equipment costs cover the physical machinery, the big excavators, trucks, drilling rigs, that sort of thing. Now, if this equipment is movable, meaning it can be used on other projects or sites later, it's generally depreciated separately, like any other piece of equipment. It's not part of the depletion base itself.
Okay, so it's just standard depreciation for those assets.
Right. But if it's immovable equipment, think a concrete drilling foundation or a permanent conveyor system built just for that mine, then it's depreciated over the shorter of its own useful life or the life of the resource deposit. Its value is tied directly to that specific site. Then you have the intangible development costs. These are a bit different. They cover costs for preparing the resource that don't result in a tangible, movable asset. Think drilling tunnels, shafts deep into the earth, or building specific access roads right into the mine or oil field. These specific intangible costs are included in the depletion base. Why? Because they're absolutely integral to physically accessing and extracting the resource. They become part of the cost of the resource itself.
That distinction between tangible, movable, immovable, and intangible development is really critical then. It sounds like you're building this really complete picture of every cost needed to get to the resource. But what about after it's all gone? I know there's often a cleanup involved. Is that part of the cost too?
It's exactly right. That's the final piece of our depletion-based puzzle, restoration costs. You might also hear them called asset retirement obligations, or AROs. These represent the estimated future costs a company expects to incur to return the property back to its natural state, or at least a usable state, after extraction is finished. This could involve dismantling structures, cleaning up any environmental contamination, replanting, things like that. It really brings in the long-term responsibility aspect.
So you're accounting for the cleanup cost way before you actually spend the money.
Precisely. For accounting, these estimated future restoration costs are considered part of the depletion base. And crucially, they are recorded at their present value, essentially, their fair value today when the obligation is incurred. Because the actual cash outflow might be decades away, we need to discount that future cost back to today's dollars using time value of money concepts. This ensures the balance sheet reflects the current economic burden of that future obligation. It's about recognizing the full cradle-to-grave cost of using that resource.
That's fascinating. Recognizing a liability now for something potentially decades away. Okay, so we've painstakingly gathered all these unique costs, acquisition, maybe some development, restoration into our depletion base. Now, the million-dollar question, maybe literally, how do we actually calculate the depletion expense for a specific period, like a year? It's definitely not like straight-line depreciation for a building, just dividing by years, is it?
You're spot on. It's quite different and actually much more intuitive in this context. Natural resource depletion almost always uses the units of production method. It's an activity-based method. And it makes perfect sense here because it directly matches the cost allocation to the actual amount of resource physically extracted. So instead of allocating cost based on time passing, you allocate it based on the volume pulled out of the ground, barrels of oil, tons of coal, ounces of silver.
Ah, so the expense tracks the actual usage.
Exactly. It provides a really clear link between the cost incurred, consuming the asset, and the benefit derived, having the extracted resource to sell. The formula itself is pretty straightforward once you have the numbers. It's a depletion cost per unit equals total cost of the natural resource minus any estimated salvage value divided by the estimated total recoverable unit.
Salvage value.
For like a hole in the ground?
Hey, usually it's zero or negligible for the resource itself, but sometimes the land might have some residual value after extraction, so it's technically in the formula. But yeah, often zero. The main parts are total cost and total units. Let's walk through a quick example, say Evershine Co. They have an acquisition lease cost of $150,000 for a silver mine. They also spent $100,000 on exploration costs. But remember, we generally expense those immediately, so they are not capitalized into our depletion base here.
Right, expensed. Got it. Then They incurred $850,000 in intangible development costs, digging shafts, tunnels, etc., to access the silver. So their total costs making up the depletion base are the $150,000 acquisition cost plus the $850,000 intangible development cost. That adds up to a nice round $1 million. And their engineers estimate they can recover a total of 100,000 ounces of silver from this mine over its life. Okay, so to get the depletion per unit, we take that $1 million total cost and divide it by the 100,000 estimated ounces.
It's $10 per ounce.
Exactly. $10 depletion cost for every ounce they pull out. Very direct. Now, let's say in their first year, Evershine extracts 25,000 ounces of silver. Their depletion expense for that year is simply 25,000 ounces times our $10 per ounce rate.
Which is $250,000.
$150,000 is the depletion expense. And how does that look in the books?
Yeah.
The typical journal entry would be a debit to inventory, silver, for $250,000.
Inventory, not expense directly.
Right, initially inventory, because you've converted the resource in the ground asset into a sellable product, the silver. So debit inventory, credit the natural resource asset account, silver mine, for $250,000. This is key. Depletion cost first becomes part of the cost of the inventory. Then, as that silver inventory is actually sold to customers, that $10 per ounce cost flows from inventory on the balance sheet to cost of goods sold on the income statement. Any silver extracted but not yet sold remains in inventory.
Ah, the matching principle in action. Cost follows the revenue.
Precisely. Now, some companies might use a contra asset account called accumulated depletion, similar to accumulated depreciation. They'd show the silver mine at cost, less accumulated depletion, to get the book value. Both methods achieve the same net result on the balance sheet. But the cool thing is how directly it links the cost to output, not just time passing. You're expensing it, like you said, per scoop or per barrel.
That really clarifies the mechanics. It makes a lot of sense for these kinds of assets. Okay, so we've covered the resource itself. But what about all the heavy equipment used? Those trucks, rigs, excavators, and maybe even more critically, what happens if, halfway through mining you realize your initial estimate of 100,000 ounces was wrong? Maybe there's more, maybe less. That seems like it must happen all the time.
You're hitting on two really practical, important points there. First, the equipment. Let's be clear. Tangible equipment used in extraction is depreciated, not depleted. Depletion is only for the natural resource itself. The machinery wears out or becomes obsolete, so it uses standard depreciation methods.
Okay, so which depreciation method?
Well, it could be the units of production method, if that equipment's useful life is directly tied to how much resource is pulled from that specific site. That often makes sense. But if it's movable equipment that might be used on several different sites over its life, then a time-based method like straight line or maybe an accelerated method might be more appropriate. The choice depends on how the equipment's economic benefits are actually consumed. Second point, changes in estimates. This is huge. Estimates of recoverable reserves, those 100,000 ounces in our example, are inherently uncertain. Geology is complex. Engineers make their best professional judgment based on surveys, test drilling, etc. But new data emerges. Technology improves extraction rates, maybe commodity prices change, making lower grade or suddenly profitable to extract. So estimates often do get revised. The crucial accounting principle here is that these revisions are handled prospectively.
Prospectively?
Meaning the change only affects the current and future depletion calculations. You don't go back and change the depletion expense you recorded in previous years.
Ah, okay. So no restating past financials just because you got new geological data.
Exactly. It avoids constantly rewriting financial history based on evolving estimates. You simply take the remaining book value of the resource, the cost not yet depleted, and divide it by the new estimate of remaining recoverable units. That gives you your revised depletion rate per unit going forward. It reflects the latest information without undermining past reporting. It really speaks to the dynamic nature of this industry. You're always refining your understanding of what's literally under your feet.
That makes sense. Dealing with uncertainty pragmatically. Okay, so we've covered a lot of ground here, literally and figuratively. If someone asked us for the absolute essentials, the cheat sheet for accounting for natural resources, what would be the key takeaways?
Yeah, let's boil it down. If we connect it all to the big picture, it's really about systematically matching the cost of acquiring, developing, and eventually restoring a site to the benefits you get from extracting the resource, all while acknowledging its unique, finite nature. So our quick hit list. Acquisition costs. Capitalize them into the depletion base if you find something otherwise expense them. It's the cost of entry. Exploration costs. Typically expensed right away, especially by bigger companies, due to the high risk. Hits current profits. Development costs. This is nuanced. Tangible, movable equipment. Depreciated separately. Tangible and movable. Depreciated over the shorter of its life or the resource's life. intangible development, capitalized into the depletion base, essential for access, restoration costs, AROs, capitalize the present value of the future cleanup cost into the depletion base, long-term responsibility recognized up front, depletion method, almost always units of production, ties expense directly to extraction activity, changes in estimates, handled prospectively, adjust future depletion rates based on the remaining costs and the new estimate of remaining units, no lookbacks.
That's a great summary. You see, understanding depletion expense isn't just some obscure accounting rule. It's really about seeing how we measure the value of our planet's resources as they're literally transformed and used up. It gives you a window into how companies quantify the entire process, from that first geological survey right through to the final land restoration, hopefully. So here's something to think about. Consider how companies balance those immediate financial gains from pulling resources out of the ground with the very real, often long-term, obligations of restoration. Does knowing how these complex costs are actually tracked and accounted for change how you view industries that rely so heavily on extracting natural resources? Does it change your perception of the true cost involved? Something to mull over. Keep digging for knowledge, and thanks for joining us on the Deep Dive.